Okay, so very good morning to you, and I'm now recording this meeting. Um, if you remember, when we met yesterday, we talked about the exchange rates from the point of view of their maturity. And we did the spot rate, which is prevailing right now in any financial market. And then we had discussion about the forward rate. The third category, in the third, the point in the same category is the future spot rate. I'll explain to you more about the futures when we discuss the risk management of the multinational companies. But right now, I can give you a small clue that the future and the forwards are like first cousins. I always make this comparison that they're like first cousins. But these two cousins are having different nature. The nature is that, if you remember the example I gave you yesterday, that there's a Belgian company and it's going to import something from Australia, and it has a fear that the Australian dollar's value can go up. And if it happens, then it can kill the Belgian company. So we want to have the forward contract. It means that if you look at the approach of this Belgian company, it was trying to protect itself. It was trying to hedge itself. It was defensive. So when you have this type of approach that you want to defend yourself, you want to protect yourself, you want to hedge yourself against the unfavorable movement of the exchange rate, then we use the forwards. But the futures are very aggressive. Aggressive in the sense that when you want not only to defend yourself from the unfavorable movement of exchange rate, but you also want to use this opportunity of fluctuation to play in the market and increase your wealth and want to be the beneficiary financially of these fluctuation. So when you are more aggressive and you're head on and you want to make some money basically out of this fluctuating atmosphere, the financial environment, then you use the futures. The futures are like the stock basically in many senses, because like the stock price go up and down, the futures price also go up and down, and you can buy them when they're cheap, you can sell them when they are expensive, and so on and so forth. So it's like trading. So the futures are traded. On the other hand, the forwards are not traded. If you remember the example I gave you yesterday, the manager of the ABC company, which was a Belgian company, that's what I assumed, goes to the bank manager of BNP Paribas, which is a bank, as you know. He didn't go to the stock market. He didn't go to the exchange, where you can do the trading, buying and selling. It means that if you buy the forward contract from this bank, it's between you and the bank. It's between the company and the bank. And there is no secondary market where you can sell it. Okay. So if I become more cynical and I give you an example that yesterday on 19th of November, the ABC company made a contract with the Australian company that they would buy the machinery or technology worth 30 million Australian dollars. And this company, ABC, had a contract with a forward, with the bank, and they buy the forward exchange rate. Now listen carefully. Imagine after 5 days, they signed the contract on 19th of November, that is yesterday. If after 5 or 6 days, the ABC decides that, hey, I'm not going to buy anything from Australia, the contract is cancelled. The contract is cancelled. It means this Belgian company doesn't need any more 30 million Australian dollars because the contract is cancelled. And if this Belgian company manager goes to BNP Paribas and says, Mr. or Miss Manager, you know what? We signed a forward contract with you because we wanted to pay a company in Australia 30 million Australian dollars. But now what happened is that our contract is cancelled. We are no longer going to buy anything from Australia. So we don't need 30 million Australian dollars. Can you please cancel the contract? The bank would say, thanks, but no thanks. It's your problem. If you have canceled the contract with the Australian company, it's your problem. On 31st of March, 2021, Mr. Manager of ABC company based in Antwerp, you have to buy 30 million Australian dollars from me. Who's saying this? The bank manager is saying this. It's your problem that your contract is canceled. You have to buy from me at a given agree. If you remember, we fixed the rate of exchange, 1 Australian dollars for 83 cents, European cents. You have to buy it from me. And then this manager of the ABC says, what would I do with them? Well, sell them or use it some other time, but that's your problem, not mine. If that contract was not signed by the bank, but rather the exchange means the big market. And if this contract was canceled, that the Belgian company is no longer going to buy anything from Australia, there would have been no problem. Because you bought the forward contract, you bought this the contract on 19th of November, just go and sell in the market. Like, for example, you buy the stocks. If I buy the stocks of KLM shares, I don't go to the KLM to sell my shares. I sell in the stock market. I can sell in the Amsterdam Stock Exchange. I can sell in London Stock Exchange. There are many exchanges where the KLM stocks are getting traded. I don't have to go to KLM and knock the door. Hey, that's your stock, give my money back. No. Same way, if the forward contract was getting traded in the market, then just you could have gone to the market and sell the forward contract. But because you buy from the bank, particular institution, particular body, specific organization, not the market, okay? Therefore, you cannot sell this contract in the secondary market. This is the forward contract's problem. But if it was a future contract, let's say you bought 30, everything was same, but you bought 30 million contract of Australian dollars in the future market. And after 5 days, you realize that, hey, you have to cancel the contract with this Australian seller. You no longer buy anything from Australian company. You will not even bother to go to this seller or who gives you this contract. You just go to the market and sell it. As simple as that. All right. So in other words, you could have been taking the advantage of the market, pre-existing market. Okay, so if I make a very hypothetical situation that you bought the future contract for 83 cents for 1 Australian dollar, and the contract with the Australian company is cancelled on 24th of November, you find that the price of 1 Australian dollar is 86 cents. Well, you bought for 83, the price is 86. You don't need Australian dollar because the contract with this company has been cancelled. Just go and sell for 86. So if the contract is cancelled, no problem. You earn 3 cents for every Australian dollar. So if 3 cents are multiplied with 30 million, goodness gracious me, it would be how much? 9. Well, you can earn 900,000 euros. You know, so this is the beauty of the future contract. So the difference between the future and the forward contract is that in the forward contract, there's no change can take place. You can't, if you buy the contract, you can't sell it. But the beauty of the future contract is that if you buy a future contract, and if the terms and conditions are unchanging, if the situation changes, like you cancel the contract with this Australian company, don't you worry, you can take the opposite position by selling it. Okay, so that's something that you can do in the future market. But as I said, that I would discuss more in details when we discuss the risk management, chapter, the topic. Okay, so now we go on. Now I'm back. Yeah, the next category that we are going to discuss is the exchange rates classified by the types of transaction. Remember, I'm going to introduce these two phrases here, the bid and the ask rate. The bid rate and the ask rate. In finance, we use bid for buying and ask for selling. Can you see these two phrases here? The bid and the ask. The bid rate is at which the bank or these currency shops like Thomas Cook and these organizations, or even MoneyGram or these, what's the name of this very famous, what is the name of this currency company? Okay, I'll find out after when I give you a break. The bid and the ask. The bid is the price at which, let's say, bank buys the foreign exchange from you. You mean the individuals or the companies. And the ask is the price at which the bank sells the particular currency, the rate of exchange. For example, you can see in this example that there is a dollar Swiss franc. So basically, if you want to buy a Swiss franc, if you want to buy a dollar, how many Swiss francs you need to give? And you can see here that if you want to buy a dollar, if you want to buy, it means the bank will sell. The bank will charge these many Swiss francs from you to, if you want to buy a dollar. But if you have a dollar and you want to sell it, if you want to sell it, it means the bank wants to buy it. Then you will get these many Swiss francs if you sell or the bank buys $1. So there's a confusion. When a bank buys, it means you sell, the people or the company sell. And when the bank sells, it means people buy. And very common, the rule is that the rate at which the bank buys is less and the rate at which bank sells is more. And the difference is the bank's income. So it would never happen that the bid rate is more and the ask rate is less. Ask price is always more than the bid price. It's like a retail company. For example, if you go to a store, you buy a chocolate. The rate at which, the price at which the bank, the price at which the shop sells chocolate to you is more than the price at which the store buys the chocolate from its supplier. So it could be possible that this store is buying the chocolate for 20 cents from a supplier, but in turn it sells the same chocolate to you at 40 cents. And the difference is this shop's income. It would never happen that it buys expensive and sells cheaper. Then the store will become bankrupt. The same way, the rate at which the bank buys a foreign exchange is less, and the rate at which the bank sells the foreign exchange is more. So one lesson, it can be very confusing. It looks simple, but it can be very confusing. Whenever you use the word bid and ask, always use from the bank's point of view. If you want, let's say if you are at Brussels airport, you want to go to Britain and you need, let's say, 500 pounds. You want to buy pounds. So don't say that you will have the bid rate, because when you want to buy the pounds, it means the bank or the shop, whichever the currency shop we have, Western Union. Yes, I was thinking about which company is that. Western Union is very famous. Yeah. So for example, if you want to go to Britain and you need 500 pounds notes and you are at the Brussels airport and you want to buy the pounds, but don't use the word bid for you. Because when you want to buy the pounds, it means the bank or the Western Union will be selling the pounds to you. So you have to buy at the selling rate, which would be higher. But let's say you buy the pounds, you count the notes, you come back and waiting for the flight, and suddenly you find that your plan to go to Britain has been cancelled, unfortunately. Now, because you don't need pounds, you go back to the shop and say, we bought the pounds 5 minutes before. Unfortunately, we don't need it. Can I sell them back? They say, yes, of course you can sell them back. But when they sell, they give you the bid price, because when you are selling, the bank or the shop is buying. And when you get the less money, you say, hey, you know what? I paid you more money when I bought, but now when I'm selling it, you're giving me less. And they will say smilingly, hopefully, or angrily, that you know what? There's a difference between the price. The price at which we sell is higher, and the price at which we buy is lower. So please, this is your loss. So please deal with it. So always remember that the ask rate, two things. The ask rate is like a retail price, and the bid rate is like a wholesale price. So the selling price is always more than the buying price. And when you use the phrases bid or ask, always think from the bank's point of view, or these private, these corporate currency shops point of view. Right? So this is the bid and the ask mechanism. Yeah. The next calculation is about the indirect or the direct quote, and at the same time, so I'm mixing the direct and the indirect quotes, and at the same time, I'm discussing about the bid and the ask rate. Okay. Imagine that the price is Swiss franc, okay? Okay, so imagine that for $1, the bid price is for this, so the price of $1, I know this is just a hypothetical example, so don't look at the actual exchange rates. So the price of $1, the bid rate is this, and the ask rate is this. Okay, and according to this rate, which rate is a direct quote or indirect quote from the USA point of view? From the US point of view, is it a direct quote or indirect quote? If you're living in the US, is it a direct quote or indirect quote?
It's an indirect quote.
It's indirect. Why so?
Because I think it's first it's saying the dollars, not the francs. I think.
Yeah, you're right. You're right. Yeah, because it should be the price should be given in the American dollars. Because if you're in the US, you buy everything with the US dollars. So why not the foreign exchange? But here, the price is that one American dollar is equal to 2.4027 Swiss franc, which is, but this is fine if you're living in Switzerland. If you're in Swiss, it's fine, but it's not fine if you're in the US. So what should you do? You need to change them to the direct quote. And how do you do it? I told you yesterday that if you divide 1 by the values, you can convert the indirect quote to the direct quote. But the problem is that if you divide 1 by 2.4027, the value will be more than when you divide 1 by 2.4051. Do you get my point? If you divide 1 by this number, the value will be more. And if you divide 1 by this number, the value will be less. So if you say that 1 divided by this number is this, that will go higher. So then the problem will be that the bid rate will be higher than the ask rate. So what we do the crossing. So if I divide 1 by this, the number would be big. The ask price has to be big, so it goes here. And if I divide 1 by the larger ask price, the number would be small, and the small number is always the bid price. So that comes here. And you can see that the bid and the ask price, now they are the direct quotes according to the US, because in the American, in the US now, the price is given in terms of American dollars for 1 unit of the foreign currency. Not only that, but also the bid price is lower than the ask price. So for example, if you have a situation in which you have to convert the bid and ask from the indirect quote to the direct quote, you can't just divide like this. So the arrow is not here to here. The arrow is not here to here. If the arrows were like this, then your bid price would have been more than the ask price, and that would have violated the basic assumption. And the basic assumption is that the bid price has to be the lower than the ask price, because if the bid is lower than the ask, only then the bank or these financial institutions will get some income. Otherwise, they will have the loss. All right. If you want, I can give you an example, and you can play. If you have Excel or if you have a piece of paper, you can do these calculations right now. So let's do that example. So I need to come out of the slide and use the whiteboard. So, okay, I hope you all can see text, okay. In Belgium, the exchange rate of $1 Australian is given as 1 euro equal to Australian dollar. Well, I think I should write like this. This is bid rate. And also have an ask rate. So the 1 euro is given as Australian dollar 1.5. Maybe, yeah, I can keep it simple, 1.5. And the ask rate is given as Australian dollars 1.6. Please tell me, is it the fine way to write, if you are in the Eurozone, the exchange rate for Australian dollar? Is it a direct quote or indirect quote?
It's indirect.
Why so?
Because the price of euro is in the Australian dollars, not. Yeah.
So you believe that it should be 1 Australian dollar here, and then something should be written in euros, right? Yeah. Do you agree? And similarly, it should be like this in euros. So same way here also, 1 Australian dollar should be written in something in euros. The question is, what would you write here? What would you write here? And what would you write here? Any ideas?
Well, 1 US 1 Australian dollar is 0.6660 euro.
How do you find it?
It's 1 on 1.5.
Where? Here?
Yes, here.
So are you saying that it should be equal to 1 divided by 1.5, yeah?
Yeah.
And here?
1 divided by 1.6.
1 divided by 1.6, okay?
I thought it would be the other way around, right?
Yeah,
Because
same.
the ask rate
Yeah.
has to be higher than the bid rate.
Exactly, because if you divide 1 by 1.5, I can assure you that it will be, okay, let me calculate. Let me prove it actually, otherwise calculate. So if I divide 1 by, if I divide 1, the problem is that with this, so many things I'm sharing on screen. By 1, I can try. Okay, so 1 divided by 1.5 equals. Okay, so this comes to be 0.667. Okay, so if I go back to the screen, so it's euro 0.6667. Let's take some 4 decimal places, and if I divide euro 1 how do I cancel it? If I divide it by 1.6, it comes to be 0.625. Okay, I go back to my, so it comes to be 0.625. And according to this calculation, the bid price is more than the ask price, right? Which is wrong. It can never happen. If the bank does like this, it will have a loss. So what we need to do is, it should be, 1 should be divided by, so we do the crossing. Can you see the cross here? So this should be divided by this, and this should be divided by this, and this should be 6250, and this should be 667. So basically, if I draw a line, it goes like this. Actually, is there any way I can remove it? Because I want to use the eraser. Yeah. Oops, I did the other way around. Oh, yeah, so if I, yeah, so this should be this, and this should be this. So I hope you can see the how the arrows are used here. So be careful that when you are converting the indirect quotes into direct quote, make sure that your condition that bid is smaller than ask should always be maintained. Okay, I hope it makes sense. Yeah. So we go back to the slides again. right, so we carry on. The next category is the cross rate. The cross rate is that if you have the, I think it'll be better if I explain the example with the help of example. I saw from Yahoo Finance some time ago that a pound is equal to $1.5223. And I find that the pound is equal to 1.4302 euros. So you can see these two exchange rates. If you have two exchange rates, can you make a third exchange rate? Of course we can. How? I can find the rate of exchange between the euro and the dollar. So I can find a third rate of exchange as well. And that is 1 euro is equal to 1.0644. And how does this 1.064 come from? Where does it come from? It comes by dividing 1.5223. We divide this number by 1.4302. And when we divide it, we get a euro is equal to American dollars 1.0644. And if I want to write in dollars, then I would be dividing 1.4302 by 1.5223. I would be getting euro 0.9394. This is called the cross rate. Okay, it's like a mathematical equation. If I say that A is equal to B and A is equal to 2C, it means B is equal to 2C, means double of the C. So you can create a third equation from the two equations. So this is like creating an equation. This is called the cross rate. And this cross rate is the equilibrium rate. This is the rate which should be. But the reality is that the cross rate is not always same as the real rate. For example, in the reality, let's say, so based on these two rates, these are the real ones. I gave you the reference for this. And based on these two rates, you are calculating these cross rates. But when you see the Yahoo Finance, you find that a dollar is equal to 0.9398. It means the dollar actually is selling for euro 0.9398. But actually 0.9398 is the real price, but what should be the price of a dollar is 0.9394. This is the price which should be of $1 American in euros. Should be. Should be means equilibrium, the normal price, the natural price. But the real price is this. What would you do in these circumstances? Can you make money? Is there any way you can earn? It basically means that the price, the dollar should be more expensive, but dollar is cheaper. And if it's cheaper, what should you do? You should buy the American dollars. I'm not saying that you should always buy, but according to this proposition, you can buy the American dollar because the price is low. The price is low than what it should be. Now, I give you one example from the non-financial context. Let's say you are very fond of certain brand of mobile phones. And you find that when you compare different kind of prices of phones, you compare all brands and all the models, you find that this phone should be at least $500 euros. And till now, you haven't seen that price check yet. And you find out that the price which you are willing to pay 500 is actually selling for 450. What would you do? There is a certain type of phone which you are desperate to buy, and you know that this price is okay. Even if it is 500, I'll pay for it. But when you are checking the actual price of this type of mobile phone, you find that it's selling for 450. What would you do? Just go and buy it as soon as possible before it becomes expensive. Same way, the price of $1 should be this in euros, but actually the dollar is selling cheaper in the market. It means that before it becomes expensive, you buy the American dollars, keep them with you, and when at some stage the actual price start marching towards the theoretical price, then you sell the dollars and make money. So basically, if the price is this, the price should be this, and if the price what it is slowly reaches the price what should be, it means that for every $1 you buy and then you sell afterward, you are able to earn euro 0.0006, which is a very small amount, actually, very small amount. So basically what you're getting is for every, if you get one euro, then you have $1. If you have, 6, yeah. For 10, it's 60. For 100, yeah. So for every $100 you sell, you can get something about maybe 60 cents. But if you are trading millions of dollars, then this gain could be huge. Okay, and this gain is called, we use a phrase in finance called arbitrage. I don't know if you have come across this word or not. We use it, we call it arbitrage. I can, if you want, I can write it down here. I can write it down. This is called arbitrage. Text. Arbitrage is a riskless profit, basically. Okay. So riskless in the sense that something should be equal to, let's say $15. But reality is that it is selling for 12. And you have a strong reason to believe that eventually the real price will touch the should be price. Then what you do? Buy at 12 and sell at 15 and make arbitrage profit of $3. So it's a riskless profit. Where is the risk? No risk. You just take advantage of the market's fluctuations. Yeah. So this is how the financial markets work, that it leaves room, it leaves opportunity for the traders, for the investors to be whichever way the market fluctuates. you can get the advantage. Now imagine that the price should be 12. I continue this example, maybe. Yeah. Imagine that the should be price is equal to 12, and the reality is 15. What should you do? Then you should sell at 15 and then buy when it is 12. So even then you make a profit. So if the should be price is more, the real price is less, then you buy first and sell later. But if the should be price is less and the real price is more, then you sell it first and then buy later. And when you buy first and sell later, it is called long position in finance. But if it happens that you sell first, when you sell first and buy later, it is called short position in finance. Okay? Make sense? So even though we're not discussing a long and short position yet, but in a way we have discussed it already. So whenever there's a difference between the equilibrium price, this is the equilibrium price, and this is the real price. And whenever there is a deviation, a difference between the equilibrium price, which should be, I should call it should be price. Whenever there is a variation between these two, there's always room for arbitrage. Arbitrage is a riskless profit. And if this is the situation, then you take the long position, which means you buy first and sell later. But if that is the case, then you take the short position, which means you sell first because the price now is expensive. Eventually the price would be 12, it will go down, okay? So in that case, you can do the opposite strategy. So you can have these are also investing strategies, long position and the short position. When there is a recession, the prices are less, so we buy things and we wait till the price goes up. So we take the long position. When there is a inflation, then the prices are going up. So the price tomorrow will be more than the price today. So in that case, what you do, you buy now and sell later. Okay, because the price will be more afterward. But if it happens that you are in the recession, in the recession means the prices are low, but tomorrow price would be even lower. So in that case, you sell something now already, and then you buy it when it becomes cheaper. The question is, how is it possible? Hey, I want to ask you something. When you buy something, for example, this is my mobile phone, okay? I hope you can see it. I can understand the long position that I go to the shop, I buy this phone is with me. Tomorrow, the price of this mobile phone goes up and I sell it and I make money. How can I do the short position? How can I do shorting of the mobile phone? Is there any way I can do it? Is it possible I can do it? You can. In the financial markets, if something is, you think that the price is more than what it should be now, today, even if you don't own it, you can sell on the promise that you will buy it within a certain time period. And if within that certain time period, the price becomes low, you have a jackpot. Okay, but it could be possible that your expectations about the future price are wrong. Well, the loss. So there is no sure, no guaranteed gain. People do take some. Depends upon your perceptions, right? Another example of short position is the bank loan. When you take the bank loan, isn't a short position, because bank gives you something which you don't own. Isn't that the money doesn't belong to you? You take it and then you return it afterwards. Sorry?
No, sorry. I think that's the long position, because when you take money, there will be like a tax, and the money will eventually, when you need to return them, it will be a little bit higher than the usual, because there's a tax rate they add when you
tax
have a
rate
loan.
or the interest rate?
Yeah, the interest rate. Sorry about it.
Yeah. No. When you take the loan, when you take the money from the bank, do you own that money? When you see the situation, if you have, let's say, okay, let me create a new text box here. You save 100 euros and you deposit. And you deposit with the bank. And you own a bank account. In the second situation, you borrow 100 euros from the bank. This money doesn't belong to you, but the bank gives you. It's like, I'm not owning this mobile phone, but I'm still selling it. So there is no ownership. But when you save the 100 euro, that money belonged to you. It was your saving. The money, you own the money. You own the money and you put in the bank, and the bank gives you interest rate. The same way, I buy the mobile phone first and then I sell it. But I own this phone. So for a day or two, I used it and then I sell it. But here, you don't own it. You borrow it. So there is no ownership, but you still make use of this money. So that way, it sounds more like a short position. And here, it sounds more like a long position, because you own this money. See from this point of view. Isn't? So in the short position, you deal with something which there is no ownership claim. But in case of long position, there is an ownership. Like, for example, it often happens with the brokers that, of course, you have to be the member of, you should have the part of that broker's team. You should be having the membership as an investor for that broker. That if the Microsoft stock is going up and up and up, it's going quite high, and it's happening for a few days, you observe that this price of Microsoft is unusually high, but it will not remain high forever. And you were just thinking, hey, I wish I had Microsoft stocks. I would have sold them now. This is the best time to sell. But unfortunately, you don't own them. You don't have them. And then you can go and ask some broker, hey, can I borrow? Can I take a Microsoft stock from you on the promise that in 2 days' time, I would bring it back to you? and you as a broker find out that, hey, there are some people who own this Microsoft stock and they're not using it. Okay, then the broker, because he owns all these stocks, he can give it to you and you sell it, make money, and then you return this money back to the broker after a few days. There we go. Sometimes it sounds like that you are going on holidays for 1 month, and you think that, you know what, your apartment would be there, and is there any way you can pay for your holidays? Well, you can put your apartment in the Airbnb or something like this, that somebody can use it, pay you rent, and this rent could be covering your holiday expenses in a way. Does it sound, do the bells ring a bit off? Yeah? I can give you one more example of a typical, I think long position is more evident, more witnessed. For instance, when you go to some store, and for example, 7-Eleven or whichever store you go there and you find that things are placed there. There is a chocolate, there is milk, there is all the food. And it means that the owner has first bought them. The person who owned the shop has bought them first and then sold to you. It means that is a long position which this shop fellow has done. The long position, yeah. The short position can be that you go to the shop and this shopkeeper is an agent basically, and you say that, hey, you are an agent of these very famous German cars. I want to buy this particular German car. And you say, the agent says, yes, you can, but give me the price first. And how much is the price? Well, the price is 20,000 euros of this second-hand car. So you sell the car first. You sell the car and this owner gives you 20,000 euros and you say, hey, the delivery will be in 3 days' time. I say, fine. So you sold, you got 20,000, and then you contact your this fellow who's a car dealer in Germany. Hey, I need this car, these specifications, and you agree, okay, 17,000, and then you buy this car and you deliver the car. You buy the car for 17,000 and you sell the car for 20,000. But see the sequence of the events. You sell it first and buy later. It would have been a long position if the car is already in your showroom and the price is written, hey, this is 20,000. But actually you have bought this car for 17,000 already. But see the sequence of the events. If you have the car already, you bought the car and then sell it to a customer, it's called long position. But when you sell it first and deliver afterwards, it's called short position. So same thing you can do in the stock market. You can also do in the Forex market, that you find that if the dollar is rising too much against euros, but this rise will never remain forever. In that case, even if you don't own the dollars, you can sell them first on the promise with your broker, the agent, that you will buy them back in certain time periods. Now the question is, when you buy them back, they can be more expensive and you can have a loss, or they can be cheaper. In that case, you have the profit. This is the risk which you take in the financial markets. Okay, so there is always a possibility of arbitrage in these circumstances. I hope it makes sense. All right, so we go to the slides again. And then we move on. And you can see that I have given you an example of the cross rates. And you can see that this data I got from, it's a long, very old data, but I can show you right now. that you can see these cross rates are often published in the journals, in the newspapers. And from there, you can find the equilibrium. These are the rates which should be. So for example, the euro into Canadian dollars should be, the should be price should be 1 euro is equal to 1.4181 Canadian dollars. For 1 euro, the UK pound should be 0.6996. But the real price may not be the same. And if that is not the same, then there is always a possibility of arbitrage. So one of them is cheaper or other one is expensive. If I have to give you an example of then I would say Wall Street Journal. And if I just want to avoid my search cross rates here. New share. So yeah, I hope you can see the screen. So you can see the cross rates, hopefully. Yeah, you can see somewhere. Not here. Wall Street Journal. We should be in the markets and the currencies. Yeah. So if I go to the currencies, then I can. Oh, there we go. Here we have the key cross rates. I hope you can see the screen. So here you can see the cross rates. For example, the price of 1 euro should be means the equilibrium rate is this. But if the Canadian dollar is not the same price, so for instance, if I open one more window and I go to Yahoo Finance and I go to get ready to answer me a question. And if I go and check the markets of the currency, actually, this is a bit confusing. If I go to the stocks, maybe here. Goodness gracious, man. Did I even choose the right page? Finance home, okay. Sorry, please bear with me. Okay, let's see with the let's see this rate. And you can see here that now the European markets are active. Yesterday when we met, the American markets are active. Now American market is sleeping and now the European markets are active. So the actual rate of exchange is 1 euro is equal to American dollars 1.1861. This is what is taking place. And when I compare the rate that 1 euro should be equal to 1.1863. This is the rate which should be 1.1863, and this is the rate which it is 1.1861. So the actual price of a euro is 1.1861 American dollars, whereas it should be 1.1862. It means that right now American dollar, a euro is selling cheaper. And this is equal to 0.0001. very less. Okay, so it leaves the room for some arbitrage. It means that euro is selling cheaper. This is the price, actual, this one, yeah. And this, oh, now it's equal. Now it's 1.18, it was for some time, 1.1862 and 1.1863. Okay, so it's still, I would say the euro is a little bit cheaper than what it should be. It means that this leaves some room for the arbitrage profit. So even though this amount is, for €1 is very small, but when you multiply with millions and hundreds of millions, then it makes a big amount, basically. So this is how the cross rate works. Do you understand the mechanism of the cross rates now? That the cross rate is difference between the price, which now even the cross rate has gone up 1.1864. So because it keeps changing, and now the price, so still it's 2 points behind 1 point, and this is more. So the cross rates are, now it's back 1.1862, and now it's, hey, now it's different. Now the price, actual price, is more than what it should be. So it keeps moving. So now the euro is, at this moment, euro is more expensive than it should be. Yeah. So yeah. So this is how you can compare the stock market, the financial markets. Same way you also have the stock price, like the forex. So this is how we work. I would be sharing the YouTube video soon with you, so don't you worry about it. But did you understand the mechanism of the cross rates? So the cross rates are the benchmarks, and then based on, against that benchmark, you can compare if the real exchange rate is more or less. So I suggest you, I give you a small homework. When we finish, go to the Wall Street Journal, because they are the one who publish the cross rates. I think the Reuters.com, the Reuters, they also publish, but the Wall Street Journal, I'm sure they do it. And then from the Yahoo Finance, you can check the actual price. And then you can make some kind of comparison between, and take the screenshots. And when we meet next time, please share those screenshots with me and give me your opinion that as a speculator, can you gain by taking the short position and the long position? And what would you buy first? What would you sell first? Likewise. So this kind of discussion we will follow when we meet next time. Yeah. So I strongly recommend you that you guys, when we meet next time, you should work more on the cross rates and discuss with me. So I said that you can take the actual Forex rate, the exchange rate from the Yahoo Finance, and then the cross rates you can take from the Wall Street Journal. This is old data, but I showed you then with the right now, the current real-time data as well. And then you can compare, you can take a few exchange rates, for example, euro with USD, American dollar, euro with pound sterling, euro with Japanese yen, euro with Canadian dollar, and those. So all these OECD countries, all the top currencies, the hard, we call them the hard currencies. So you can create the cross rate table and the real rate table, and then make some comparison and give some judgments about it. And that will be a starting point when we meet next time. Okay, so that is what we should do next. But now very quickly, I give you 5 minutes break. And when you come back, then we will carry on how to measure the change in the rate of exchange, right? So I give you 5 minutes break and then we continue. It's 19 past. So let's start at 24 past. And then half an hour, and then we will finish our lesson, and I'll give you some homework then. Resume the recording now. So I repeat that if you want to find the change or the movement of the exchange rate, we always show it in the, well, we don't show always, but I normally prefer to show the word delta or triangle as a change. And I can make it change in coefficients, or if I put the percentage sign, it can also be shown as a percentage. And this is equal to the bracket starts, the rate of exchange currently minus the rate of exchange in the previous time. The previous time can be 1 year before, 1 month before, a day before, or a minute before. So that is called as the previous rate, because I put -1. It means not now period, not the current period, but a period before the current period. And I close the bracket, and again, I divide by the rate of exchange, which was a period before. And if this value, and remember that these rate of exchange has to be the direct quotes, no indirect quotes, direct quotes. It means the number of the one unit of the foreign exchange, foreign currency, should be written in certain number of the local currency. Okay, so remember that, don't give up this this rule of direct quote. And if this number is positive, then it's called appreciation, which means that the unit of the foreign currency has become more valued. And if this number is negative, then we use the word depreciation. And you can see these words here, appreciation or depreciation. So for example, here we see that in this time, 2002, the yen went up from, I didn't say up, but the yen went from this price to this price. So we find that this is the old price. So this is T minus 1, ST minus 1. And this is the new price, which is ST. Okay. So what we find, we know the formula. It's ST minus 1 and divide by ST minus 1. And it comes to be 0.003% because it's positive. If it is positive, then it's appreciation. But if it is negative, for example, here, then this is called depreciation. So we can say that yen has appreciated against American dollars by 0.003%. Same way, if you say that yen appreciates against dollar, it means dollar depreciates against yen, but the number will not be same. What is same is that when yen appreciate against dollar, then dollar depreciate against yen. But it doesn't mean that the amount, the numbers would be same. You can see here, based on these rates of exchange, I changed the direct quote or the indirect quote. So now I convert them to dollar. $1, how many yens? The bid price, the previous price, and the new price. Likewise. And when we put the new price minus the old price, divide by the old price, it comes to be negative. It means that the dollar depreciates against yen by 0.002%. I hope you understand my point of view. What I'm trying to say is that when yen appreciates against dollar, dollar depreciates against yen, but the value will not be same. Look, the appreciation of yen against the American dollar was 0.003%, but the depreciation of dollar against yen is 0.002%. So make sure that you have to be careful. So we have another example. We have the rate of exchange here. This is the euro versus dollars. And let's do it in Excel and see who appreciates and who depreciates. So I'm copying it. And then I open an empty Excel. And then I share the file with you. The new share, the spreadsheet. And I hope you can see the spreadsheet now. And I paste the question here. So here we have, let's call it euro one. Yeah, so let's call it euro here. Sorry. I can zoom in so that you can see more clearly. And so we have euro, and then we have the dollar. Yeah, euro and dollar. Yeah. And I can say that it says that the euro goes from this to this. So it means that the old exchange rate is T minus 1. T minus 1. The previous one is 1 euro is equal to 0.93. 0.93. Can I ask you that, from which country's point of view, this is the direct quote, and from which country's point of view, it's an indirect quote?
Direct quote from the USA and indirect from Europe.
Very good. So the rate of exchange used to be 0.93 American cents. And now this goes to 1.09. 1.09. Yeah. And here, sorry, there are so many pop-up messages because I'm taking part in this conference. So what is the formula? The formula is that we say the current price minus the previous, divide by the previous. And here we find that the number comes out to be, so if I format the cell and change to percentage, it comes out to be 17.20. Because it's positive, so it's called appreciation. So I can say that because we are living in the US, according to this example. So it means that if I put a comment, new comment. So if I can put a comment, I would say that euro appreciates against USD, US dollar by 17.20%. Here we go. Euro appreciates against the USD by 17.20% because the value is positive. Now, what we do the opposite. We know for sure now that if the euro appreciates, then the dollar depreciates. That is for sure. But how much, that we have to see. So what I do here, this time I change the position. So I call first as dollar and then euro here. Then I write euros. And I still write the old exchange rate, T minus 1, T minus 1, and the new exchange rate, which is ST. But this time, sorry, not T minus 1 here, only T. And this time I write not 1 euro, but this time I write $1, 1 and 1. And how do we convert the rate of exchange? Very simple. Remember yesterday? 1 divided by this. And here, 1 divided by this. I'm sorry, this went something wrong. So this is equal to 1 divided by this number. Here we go. So price of 1 euro in dollars was this much, but the price of $1 in euros was this much. And then there's a change. And then what I do, I apply the same formula. And when I apply the formula, come on, then it becomes the new price minus the old price mean exchange rate, basically. So don't confuse it with that. So, and then we put against the old ones. And here we go. And now you can see that this number is negative. So if I format the cell into percentage, and it comes out to be, so you can see that euro appreciates against dollar, but the dollar depreciates against the euro. How do you know it? because the sign of the calculation is negative depreciation. And if I put a comment, I can say, is it 14.68 here? So I can say that dollar depreciates against euro by 14.68 percentage. Here we are. Euro appreciates against dollar, dollar depreciates against euro, but the value would not be same. So if it goes up by 2%, doesn't mean that this goes down by 2%. It has to be different. So that is why not only you should know the trend of the mutual trend, but you should also be able to calculate how much is the appreciation and how much is the depreciation. Does it make difference? Do you understand this mechanism or not now?
Yes.
Okay, and also have the direct quotes. This is a direct quote from American point of view, but this will not be the direct quote from the European point of view. So in that case, you have to, change the exchange rate. And the formula is very simple. You just have to 1 divide by the exchange rate. So this is how it goes. And then we calculate. So I'm not saving this file, but of course you will be able to see it when you see the, when you see the video. And now I have 2 videos to share with you. The one I have almost shared because it's uploading. And this one also, you will see it soon. So next week, when we meet, I expect from you that you should be very well versed in the cross rates. And secondly, you also take some numerical data from Yahoo Finance or Wall Street Journal and calculate the appreciation and depreciation of 2 or 3 currencies. I would say that you compare the euro, dollars, USD, GBP, the pounds, the Australian dollars, and the New Zealand dollar, maybe Canadian dollars. Yeah. So try to make their mutual comparison based on the previous rate and the new rate. The previous means it could be yesterday's price, exchange rate, or it could be a year before. That is up to your choice. So make some mutual comparison of these rates of exchange, and then find out that who appreciates against who and how much, and who depreciates against who and how much, and then the cross rate. So I'm giving you some work to do. I hope you do it. I'm not telling you too much because I want you to explore these things by yourself to begin with. If I tell you too much, then you will not think beyond that boundary. But I have given you the broad outline that I want to see that how you manage the cross rate calculations and how you find the appreciation and depreciations of the currencies. And remember that if I go too much into theory, you will find it a bit complicated to do this calculation. But now I'm showing you with the real life situation as well. So I hope that you can relate that information to your calculations. So with this, we close our meeting for today. And now we shall be meeting next week. And soon I would be sending you the YouTube videos. Of course, I will not send you directly. I will send to Catherine, and then Catherine would be sharing it with you. Yeah. So with this, we close our meeting, and I thank you all. And I also wish you a fantastic weekend and see you next week.
Thank you. Have a nice weekend.
Thank you so much.
Thank you very much. Have a nice